Hello and welcome to FT Markets. The subject today is surprises. Last week, after dropping hints for several weeks that the ECB was going to do something more to stimulate the European economy, it did. However, it didn't do as much as had been expected, cutting the deposit rate, extending its purchases of bonds, but not increasing the amount it's going to buy each month. This has had some considerable effect in markets. And to discuss the consequences and what happens now, I'm joined by Roger Blitz, the FT's currencies correspondent. Hello, Roger. So talk us through what the reaction has been.
It was very dramatic. Everybody, as you were saying, were expecting a lot of quantitative easing by the ECB, but because they were very, very priced short euros, and because the ECB did not do what they expected, we saw this massive rise in the euro. We've been expecting the euro to continue to sell off towards parity with the dollar, but instead the ECB didn't deliver what the market expected, and therefore we saw a big, big rise in the euro.
Yeah, massive is a word we try to avoid using, but I think we've got a chart here which shows, in this context, perhaps it is deserved.
Absolutely. The lightly shaded bar is last Thursday, and that's a 4.3% move in euro dollar. And as you can see, that's the third biggest ever since the creation of the euro. And funnily enough, the second biggest was also this year in March, when policy divergence, the thing that's been driving the trade of euro dollar, the most heavily traded exchange rate in the world, was at its height. And we have been expecting that to return, and that was where the market thought it was going, but it's just gone in the wrong direction.
Divergence has been this word which we've heard a lot recently. So the US central bank looks like it's going to be raising rates, whereas in Europe we're still on stimulus, cutting rates, trying to stimulate the economy. So what does that mean now for trying to predict the future path of the euro from here?
People still have faith that the euro is going to fall. If we look at our next chart, we can actually see that the problem that people have had is that the trend hasn't quite worked the way they expected. This is the last 6 months. You can see that the euro started 6 months ago around 112 against the dollar. And you can see the fluctuations. There you can see right at the peak was the China shock in August. But since the divergent story has been coming back, the trend has been going further down. Then we have this marked rise on Thursday, this 4% rise. And actually today we've had again this bit of a sell-off again. So people want to believe that the euro is going to continue to sell off. And now they're focusing on next Thursday's key meeting, the Fed meeting, which is expected to raise interest rates. So in other words, this divergence is going to happen one way or another. Whether it happens more weighted from ECB monetary easing or US monetary tightening, I'm not sure traders care or bother that much. But one key issue is that if the ECB is going to stop easing as much as people expected, to what extent is the US going to push monetary tightening further and further? So in other words, people are looking at not just when it's going to happen. Clearly, we're now pricing in about 80% probability of a US hike next week, but the path it's going to look like next year.
Indeed, because I think it's bang on. Everybody expects the Fed to raise next month. But when you talk to investors about what they're thinking for 2016, you find a very big divergence between the path of interest rates after that. Everyone talks about the terminal rate. How high are interest rates going to go once they start raising? And I think if we look at market expectations, the market is broadly pricing in that US policy rates will be somewhere between 50 and 100 basis points at the end of next year. That would mean the Fed is going to raise, but isn't going to raise very aggressively afterwards. But then if you think about wage inflation, which is starting to come through in the US, if you just look at what the central bankers are saying in the dot plot, which is where they show where they predict rates to be at the end of next year, that suggests rates will be higher at sort of 1 to 1.5%. And that could really surprise the market, I think, if we get a more aggressive raising schedule than is currently expected.
Yes, that's absolutely right. And I think what people are quite confident is the next few months, because what we also had last week was the payrolls data out of the US, which actually was very robust, or at least robust enough to give confidence towards this hike next week. But what we're always going to be looking out for is data that is going to go against it. And people are saying what is going to be the thing that's going to upset their forecasts. And the two key ones are inflation, and if you like, connected to that is basically the state of the US economy, how fast jobs are going to be created, and the extent to which it goes too far and too fast for Yellen to control. So therefore, where we see the next 6 months feels quite comfortable. But once you get beyond that, people aren't really comfortable in making those forecasts beyond.
Great. Thank you, Roger.